When you begin earning, you are very, very conscious about the income and protecting that income, because all the investments you make in yourself, in your equipment, in your enterprise, in your home, in your vehicles, all the assets that you build initially to be able to keep a stable income coming, all of these assets can be subject to risks. Now that sounds like a very pessimistic way of looking at things, but there is so much we take for granted in life. We assume that we will enjoy great health. We assume that we will live long. We assume that this nice, expensive computer we are working with is not going to give up on us. But there is so much that's uncertain, and this can come and hit our incomes. Look, for example, at the poor. Look at the farmer whose crop fails. He's made those investments, but his crop has not yielded what he expected it to yield. He's so crippled for the lack of that income that several of them have been pushed to the point of suicide because their investments have gone wrong. Look at your maid or your driver. What would you find as the most important financial problems they might have? You find that their income is limited, and somebody falls ill in the family, the entire finances have gone out of array. They can't take the fact that an earning member has fallen ill. So before you begin to invest, before you begin to make those long-term plans, make sure that you have insured. Insurance is a very cost-effective and efficient way to protect yourself from those unexpected events that can harm your ability to earn an income. So what should you insure first? Very obviously your life. If there are dependents on you, if your income matters a lot to somebody else who you are leaving behind, your parents, your spouse, your children, you must insure your life first. Second, health. Whether there is a permanent or a temporary disability, you would want your income to be protected, and you would want to have some time before you're back on your feet. So buy that health insurance for yourself. And then the general insurance for your car, your valuables, your home, your equipment. So everything that supports you in making that income can be protected through what is called the general insurance. So you have these three segments. You have life, you have health, and then you have general insurance. You will need all of these three products when you begin. So how does insurance work? Insurance works on the simple idea of large numbers. The insurance company will actually have specialists who are called actuaries. It is a job of the actuary to make a forecast of how often and how much will be the liability of the insurance company to pay up. Suppose you have taken a life insurance, the actuary will make an estimate of what might be your life expectancy, and of the entire group that has been insured, how many are likely to make the claim. So as there are more and more people who join or who buy the insurance policy, the probability that all of them will suffer the risk at the same time falls. Now because of this, the contribution of each person, which we call as the premium, the amount you pay to be able to be compensated, it falls. So you pay a small premium and you enjoy a larger benefit if the event were to occur. Because of this structure, the insurance company which actually provides you the insurance will hold the right to include you or not. So you might have seen that insurance advertisements have this line, insurance is a matter of solicitation. What does this mean? The insurance company will take a call on whether you are a risk they like to take or not. You might be a terminally ill person. You might have a much lower life expectancy than the others. Now by including you in that group, the premium of everybody is likely to go up because your probability of passing away is higher, which is why the insurance company will hold the right of including you or not. So you can ask for insurance. Whether you will get it or not is a matter left to the insurance company. So how would you buy insurance? You would look at products that offer a cover against a risk. You will find out what is the risk that's being covered, and you will look at what is the premium that is being offered for your age, your circumstances, and your claim. And based on that, you will decide that you will buy a policy. There is this number which is called the sum assured. This refers to the number or the amount that will get paid to you if that risky event were to happen. To get that sum assured, you pay a premium. Now, in the market, there are several products which don't offer insurance alone. They club insurance and investment. The most popular product in this category is the ULIP, or the unit linked insurance plan. So what happens here is your sum assured, or the amount that will get paid to you, depends on not just the premium but a part of that premium which will get invested. So these are insurance plus investment bundled together. Is it wrong to bundle them? Not really, but it's expensive to bundle them, and you might end up with a product which might not suit your requirements. You have to be careful. There are several structures that insurance companies build in. Many of these products are fairly complex and complicated. So before you buy insurance, you have to understand what is the premium, what is the cover, what are the conditions on which you will get the money back, and what is the cost. And secondly, you should know whether any part of the money that you're paying is going towards investment, and whether this component can be handled by you separately. Do you really require it to be bundled or not? So many buy insurance just because there is a tax concession, or they commit to buying an insurance policy because they think, oh, this is compulsory saving and I'll pay this premium, I'll save this tax today and continue to pay the premium, and they overestimate their ability to save. Soon enough they find that they're not able to pay the premium and the policy has lapsed and there is a loss. Spend a little time to understand your product. You might buy a good insurance. Insurance is not a bad word. There are several investors who run away because of all of the problems that have surfaced and say, oh no, I don't want to buy insurance. Insurance is a product you will need. You will need insurance before you begin to do anything else. But you must buy carefully. Make sure that you have got a product which you understand. Don't buy just to save tax.